Hello, I'm Professor Brian Bushee. Welcome back for another week. This week we're going to have a few videos on ratio analysis, and then we'll do the mid-course exam. Ratio analysis is a good topic to do this week because it's going to basically review a lot of the material that we've covered so far. After all, there's not much to computing ratios. It's just dividing one number by another. But the real challenge is trying to understand what those ratios are telling us. And that forces us to reverse engineer the financial statements, to think about what are the transactions that must have happened to get into the financial statements to produce these ratios. So in other words, what are the ratios telling us about the underlying transactions the company must have been doing? So in this video, we're going to talk about some tips for using and misusing ratios. And then we'll go through something called the DuPont analysis, which is a very common analysis technique which is used to understand return on equity, one of the most important measures of how a company is doing. So let's get started.
Let's start by talking about how to use ratios. So ratios are going to be useful in assessing profitability, liquidity, and risk. They're going to highlight sources of competitive advantage, so what areas of the business is the company doing really well, and red flagging potential trouble, so what areas is the company not doing so well in. But to do this, we have to compare the ratios to a benchmark. There are no absolute benchmarks, so there's nothing like ROE, return on equity greater than 0.16 is great, below 0.16 is bad. They have to be compared either to the same firm across time, so we call a time series analysis, so we're looking in trends for the firm, or compare the firm to other firms or to the industry, do what's called a cross-sectional analysis. And this is important sometimes because the firm trends could be driven by industry effects. And so to figure out whether it's the company doing something well or it's just an industry-wide phenomenon, we have to both look at the same firm across time and compare that trend to other firms or to the industry averages. Ratios are contextual. There's no such thing as a ratio being good or bad news. So it's not like an increase in return on equity is good news. It could actually be bad news. What we're going to try to do is figure out what activity drove the ratio to be at the level it's at or drove the ratio to change like it did. And then once we understand those activities, then we can talk about whether it represents good or bad news. And that gets to the overall key. Ratio analysis is not going to provide you any answers, but instead it's going to help you ask much better questions.
My sister once told me that ratios provide all of the answers. She is a long-short hedge fund guru in Hong Kong. What are your qualifications?
Well, I'm not a long-short hedge fund guru. And I guess there is that old saying that those that can't do, teach. So I don't have those kind of qualifications, but I do have a lot of experience working with financial statements. And I'm pretty confident in my claim that ratios are a really good diagnostic tool to help you identify problems that you need to look into further, but they're rarely going to give you all the answers.
Now let's talk about the flip side, which is how to misuse ratios. One of the ways that people often misuse ratios is they don't realize that standard ratios have multiple definitions. There's no gap for ratio definitions, or I guess it would be GARD, generally accepted ratio definitions. And what can happen is there's a lot of little differences you could do in your definitions. And if you don't know how the ratios are defined, and they're defined differently across companies, you could get faulty comparisons. So make sure you're using the same definition of a ratio to get valid comparisons. Also, choosing the appropriate benchmark for comparison is important. So we talked about how ratios have to be compared to a benchmark. But if there's major changes in a firm, it's going to mess up your time series analysis. You aren't going to be able to look at the trend over time for the firm and draw conclusions. If there's any kinds of differences in business strategy, capital structure, or business segments, it'll distort your cross-sectional analysis, your comparison of a firm to other firms or to the industry. And then differences in accounting methods can make all of these comparisons difficult, and you may need to make adjustments to get rid of the differences in accounting methods.
That preceding passage was a fair bit too abstract for me. Can you elucidate this further with some relevant concrete examples?
Yes, I can. So for the major changes in the firm, Imagine a software company goes out and acquires a hardware company so that they can integrate their software into the hardware. What that does is it essentially makes it a different company, and you're not going to learn much looking at the time series of the ratios for that company. I'll talk about the differences in business strategy in a detailed example near the end of the video. And the changes in accounting method, we saw a big one last week with LIFO versus FIFO. If you were comparing two companies, one used FIFO and one used LIFO, almost all of the ratio differences are going to derive from the fact that the inventory costs are so different between the two. You would need to take the LIFO firm, switch it to FIFO, and then compute its ratios before you could do any meaningful comparisons.
Final thing to keep in mind is that ratios can be manipulated by managerial action. So if managers think that investors and analysts are all focused on the same, let's say, interest coverage ratio, then they have incentives to manipulate their accounting numbers to try to make that ratio look good. So always keep in mind that manipulation is one possibility, and more importantly, don't focus on just one ratio, but look at the whole body of ratios, because it's hard, in fact, probably impossible, to manipulate every ratio so that it's going to look good. So now let's go and talk about specific ratios, starting with return on equity. So is a net income of $10 million good or bad?
I could live with 10 milli. Sounds like a great net income to me.
Yeah, if you were running a lemonade stand and your only assets were a table, a pitcher, some glasses, and a bunch of lemonade, and maybe a cool Letterman's jacket, then 10 million in net income would be pretty awesome. But if you had billions and billions of dollars of assets, then 10 million is pretty meager. So what we need to do to assess whether 10 million of net income is good or bad is look at how much investment it was required to get that 10 million.
So to assess whether net income is good or bad, it depends on the level of investment required to get that net income. And that's what return on equity is going to tell us. Return on equity is net income divided by average shareholders' equity. So the numerator is telling you how much return the company generated for shareholders during the year based on our accrual accounting. The denominator is going to give you the shareholders' investment in the company. Now, one problem is that net income is something that happens over a period of time, whereas stockholders' equity is a point in time. So we need to take the average of stockholders' equity to sort of approximate where it was over the year that matches net income. This is one of the places where you might see people use different ratios. Sometimes they'll just take the beginning balance of stockholders' equity as the denominator. In any case, this ratio is going to measure return on investment. So for every dollar the shareholders have invested in the company, how much net income does the managers produce? This number should increase with the risk of the company. For example, I could take $1 and put it in a savings account with a bank. I would get roughly 1 cent of interest a year, so my return on investment would be 1%. If I'm going to take that same dollar and invest in a company, I'm taking much more risk. There's much more risk that I'm going to lose that dollar. So I should get a higher return. I should get an ROE greater than 1%. So we looked at this ROE, the amount of net income that you get for each dollar of investment, is something that should go up as the riskiness of the company goes up. Now we're going to divide ROE into two drivers to try to figure out where a company is either getting high or low ROE. First driver of ROE is going to be operating performance. So how effectively do managers use their company resources, in other words, their assets, to generate profits? The ratio we're going to look at here is called return on assets. ROA is defined as net income over average assets. So what it tells you is for each dollar of assets that a manager has to play with, how do they turn that into net income? The second driver of return on equity is financial leverage. How much do managers use debt to increase available assets for a given level of shareholder investment? So financial leverage is going to be average assets over average stockholders' equity. So in other words, for each dollar that you get from shareholders, how many assets do you buy? Now, if you took on no debt, then financial leverage would have to be 1. For each dollar of shareholders' equity, you can buy $1 of assets. What debt allows you to do is, say, for every dollar of shareholders' equity, go out and buy $5 of assets by taking on $4 of debt. Now note that this is different from many of the leverage ratios that you hear about, like debt to equity, and we're going to talk about those later in a later video.
Pardon me, my sister just texted me back that you need to delete the net income in ROA. Moreover, she said debt to equity is a better leverage ratio than your financial leverage.
You know, I agree with your sister on this one. We do need to de-lever net income for ROA, but we'll get to that later. So I want to keep it simple at this point so that you can see the concept about how there's two drivers of ROE. And there are different measures of leverage which are perhaps better suited for assessing long-term liquidity and bankruptcy risk, which we're going to talk about in a later video. The financial leverage, though, is the right measure if you want to see whether the return on equity is driven by leverage, by borrowing a lot of money.
Let me show you a picture to tie these together and do an example. So we've got return on equity as our sort of bottom line return on investment measure, and that can be split into operating performance, return on assets, and financial leverage. So ROE equals net income over assets times assets over equity. You can see how that works. The assets would cancel, and so you'd have net income over equity. So anyway, an example would be a company raises $100 from shareholders by issuing stock and borrows $100 from a bank. So we raise $200 total, $100 in equity and $100 in debt. We use that $200 to buy $200 of assets. Then we go and run the company, and we're able to produce $10 of net income by using those $200 of assets. So our ROE would be 10%. $10 of net income divided by $100 of shareholders' equity. ROA would be 5%. $10 of net income divided by $200 of assets. And leverage would be 2. $200 of assets divided by $100 of equity. And as you can see, 10% equals 5% times 2. You can also see how these would be drivers of ROE. So let's say we could increase our leverage to 4. So we were able to buy $400 of assets for our $100 of stockholders' equity. So we take on $300 of debt. If we take 4 times 5%, we're able to maintain the same ROA. All of a sudden, our ROE doubles up to 20%. And similarly, if we can hold leverage constant and increase our operating performance, increase our ROA from 5% to 10%, that would get us to a 20% ROE as well. So both operating performance and levering up, borrowing more money, are drivers of increased ROE.
I am completely and utterly flamboozled by your example. Did you not inform us mere seconds ago that one must utilize average balances?
I'm really sorry to flamboozle you. I'm trying to keep it simple here. I wanted to do an example which really clearly illustrated how these two factors, ROA and financial leverage, combine to drive ROE. And yes, if I was doing these ratios in practice, I would take the average of the beginning and ending balance for the assets and for the equity.
Now that we've separated ROE into what's driven by operating performance and what's driven by leverage, we can drill down further into the ROA component because there's two big drivers of return on assets. The first is profitability. How much profit does the company earn on each dollar of sales? Here we're going to use a ratio called return on sales, ROS, which is going to be net income divided by sales. So for each dollar of sales, how much net income does the company earn? So each dollar that goes to the top line, we subtract out all the expenses. How much is left when we get to the bottom line net income? The other driver is efficiency. How much sales does the company generate based on its available resources? In other words, how efficient are managers at taking their assets and turning them into sales? So here the ratio is going to be called asset turnover, which is sales divided by average assets. So for each dollar of assets in the company, how effectively do the managers turn that into sales? Now I'm going to go through an example where we'll talk about these more in detail later, but first we have to do a little complication and go back to this problem of ROA and leverage that came up in the question earlier. Ideally, return on assets would measure operating performance independent of the company's financing decisions. So we want to pull out all of that leverage into the financial leverage ratio so that ROA only measures operating performance. The problem is that the numerator of ROA, net income, includes interest expense, which means that the more leverage you have, the more debt you take on, you have a higher interest expense, and interest expense reduces net income. So if we just use net income as the numerator of ROA, it has a leverage effect in it because it includes interest expense. So to remove that effect of financing, we have to do what's called de-lever net income. Once we do that, then we're going to define ROA as de-levered net income divided by average assets, where de-levered net income is going to be net income plus 1 minus t times interest expense, where t is the tax rate. So we're taking the after-tax interest expense, adding it back to net income. That's going to be our leverage-free measure of net income that we're going to use as the numerator in ROA.
Ideally, you could explain this 1 minus t stuff. And it would not hurt to explain what de-lever means, and why we add interest expense to de-lever.
Yeah, I know the formulas are a little bit abstract, so let's go through an example to see how this works.
So here's the example of why we need to de-lever net income to calculate ROA. So let's say we have two companies, one that has no debt and one that has some debt. They both have the same pre-tax, pre-interest income of 300. So that's EBIT, earnings before interest and taxes. So it looks like they have identical operating performance at this point. The company with no debt obviously has no interest expense, so their pre-tax income is 300. The company that has some debt has some interest expense. It looks like a fairly high interest expense in this case. And that reduces their pre-tax income to 250. Then taxes are 35% of pre-tax income. So our no debt company has net income of 195, but our some debt company has net income of only 162.5. If we just use this net income as a denominator in ROA, it would look like the some debt company is not performing as well. When in fact, they have the same performance, it's 300 in both cases, pre-tax, pre-interest income. So we need to de-lever net income for the some debt company. So we take 162.5 plus 50 times 1 minus the tax rate. And what you see, that removes the interest expense, it removes the tax effect of having the interest expense in there. And we get to the same de-levered net income. So we put that now into ROA, and we'll get the same conclusion that these companies have similar operating performance. So what we're going to do is for ROA and return on sales, we're going to use de-levered net income. For ROE, we want to use regular net income because ROE is after including the effects of financing, and so we want the effect of financing to show up in net income as well. The way to tie all of this together is something called the DuPont ratio analysis framework.
Hey, is this the same point that makes the model airplane glue?
It is pronounced DuPont. It is named after Helios Irene DuPont.
Yes, this formula was actually developed by a couple people that worked for the DuPont company. They later moved on and took jobs at General Motors when it was run by Alfred P. Sloan earlier in the 20th century. And it was there that this analysis tool really became popularized, and Sloan referred to it as that DuPont formula. So we still use that name today.
So anyway, we saw that ROE, our sort of baseline measure of what's the return on investment that shareholders are getting for each dollar of equity, how much net income can they get. That can be split into two drivers, return on assets and financial leverage. Return on assets, the operating performance piece, can be further split into return on sales, profitability, and asset turnover, efficiency. So we can see here that ROE equals net income over sales times sales over assets times assets over equity, or profitability times efficiency times leverage. So three drivers of ROE. You could have profitability. For each dollar of sales, you generate a lot of net income. Or efficiency. For each dollar of assets, you generate a lot of sales. Or leverage. For each dollar of equity, you generate a lot of assets.
May you elucidate this further with a relevant concrete example of how one might utilize this DuPont formula?
Yeah, so let me talk about an extended example of using the DuPont formula. and would also highlight the importance of conditioning on business strategy. So we talked about earlier in the video how differences in business strategy can mess up ratio analysis. Well, this will be an example of how. So if you think about the retail industry, there's a couple big segments in it. One segment would be the discount retailers, so the kinds of stores that have Mart in their name. And then you have a segment which is really high-end retailers, the ones that tend to be in the expensive shopping districts downtown in big cities. So if you were looking at the discount end of the market, the Mart type stores, their strategy is going to be very low profitability. So they have very small markup over cost. They try to get you in the store by low prices. So how do they get high ROE? Extremely high asset turnover. So for every dollar of assets, they generate a lot of sales. How do they do that? Well, their assets are things like rather plain stores located in rural districts where the land is not that expensive. If you go in the store, there's not fancy displays. The merchandise is sort of crammed in there. And it's really a strategy of trying to maximize the amount of volume that they can get for their level of assets. Now, if you were looking at one of these Mart stores, you'd only want to compare them to other stores doing the same strategy. And if you assume that profitability is something that would be hard for them to increase because of competitive pressure, then you really look to see whether they're getting higher asset turnover as a way to get a competitive advantage and get higher ROE. On the opposite end of the spectrum, you have the stores that are located in the very expensive shopping districts. So what I've heard these stores are like, I've actually never been in one because I order all of my clothes over the internet. But I've heard that they're very beautiful stores, nicely laid out. The merchandise is not crammed in there. There's very beautiful displays. They're spending a lot on assets, and so their asset turnover, the amount of sales they get for each dollar of assets, is fairly low. But once they make a sale, their profitability tends to be very high markup over cost. So in this segment, you want to compare the high-end retailers to the other high-end retailers, and you look for any advantages they have in squeezing some extra profitability out of their operations in order to get a higher ROE. So what this formula allows you to do is isolate where the ROE is coming from, and if you're comparing a firm to other firms doing the same strategy, you can really identify is whether they're getting those advantages in the part of their strategy where they're trying to get those advantages. And we're going to do this more in the case in the next video. So as I just mentioned, what we're going to do in the next couple videos is apply this ratio analysis technique, the DuPont formula, to a case study of a company that has had some difficulties, changed its strategy, and now it seems to be growing very well. But we'll see what stories the ratios can tell us about how the company's doing. I'll see you next time.
See you next video.